Right, so good morning and welcome to our wrap up session for corporate reporting July 2026 examination. And in this session is going to be just a brief session for us to share our thoughts on some few things and then possibly be out of here in the next few minutes. We have spent the time to look at the various things that we must understand to put us in the position to pass the examination with the corporate reporting exclusive discussions and issues. We have spoken about the issues in respect of the specialized transactions. Question number 4, waiting for us in the exam hall that we need to understand the issue in respect of business valuation, corporate restructuring, financial reorganization. That's going to be in the exam hall. One of them will be there for 15 marks. We have discussed that at length, solved questions in respect of that. So one of them will be there. Then we've shared our thoughts also on the issue in respect of evaluation of financial statements and the exclusive thing in corporate reporting, which is the cash flow analysis, the preparation of the consolidated cash flow. We did that on Monday during our discussion in respect of that and spoke at length, solved a couple of questions in crystallizing the principles on the corporate reporting exclusive issue. Then question 3B, which is going to be a question on governance, sustainability, ethics. We've also discussed that and brought the discussion home. 10 marks question waiting for us in the exam or on question 3B, which is going to be either ethics, sustainability, or issues in respect of corporate governance. 10 marks question 3B waiting for us in the exam hall. So question 5, evaluation of financial statement. We've addressed everything we need to understand there, emphasizing that the evaluation of financial statement in corporate reporting is not just about calculation of the ratios using financial indicators, but also we are going to be using non-financial performance indicators, which means that we are going to be using social issues, environmental issues to evaluate the performance of the entity. So not only are we going to be doing financial performance, we're also going to be doing some non-financial performance. Then we spoke about the issue in respect of the question 4. So we've addressed the issues in question 4. Then we come to the question number 3B, which is going to be sustainability, ethics, and issues about governance. That also has been addressed. Then question 2 and question 3A, 30 marks question waiting for us on the accounting standards. We have spent the time to cover 95% upwards of the accounting standards. We've looked at IFRS 2 share-based payment and the deferred tax implication on that. We've spent our time to look at IAS 19 employee benefit and the various things that we must understand there. We've also looked at the issue in respect of IFRS 8 operating segments, the various issues that we must understand there, and certainly the other accounting standards. Like in the previous session yesterday, we shared our thoughts on earnings per share as well as sale and leaseback that we need to understand IFRS 16. So if we look at the discussion very well, we have covered at length everything that we need to really understand to put ourselves in the position as we are going into the examination. So question 2, question 3A, 30 marks question waiting for us on the accounting standards. And we have covered 90% upwards of the accounting standard. The 30 marks question, you're going to see there everything that you're going to see there, 5 or 6 accounting standards that the examiner is going to be bringing. A standalone 30 marks question, we have covered all of the standards that we need to cover to put you in the position to pass the examination. Then we go back to question number 1, which is consolidated financial statement. Yes, we mentioned that this should be your last question in the exam hall, or if anything, last but one question in the exam hall when it comes to the examination. And we've addressed some of the key issues we need to understand. As I mentioned on the Monday discussion in session 3 in our revision session, as we did, we spoke about the issue in respect of preparation of the consolidated cash flow statement, and we look at the analysis of the consolidated cash flow statement, and we also spend the time to look at the various adjustments, change in group structure and dividend, how that affects the cash flow statement, and we discussed all of those things during that session. We've also looked at foreign subsidiary and how the various workings must be done in respect of foreign subsidiary in that question 1 area, consolidated financial statement. Now, the issue as well is in the fact that when it comes to the consolidated financial statement here in corporate reporting, we are going to have the examiner embedding standards in the footnote, quite a number of standards in the footnote that we must understand. And so we've solved questions where we see IFRS 2 share-based payment in the consolidated financial statement environment. We've seen IAS 19 employee benefit in the consolidated financial statement environment, as well as other accounting standards in the consolidated financial statement environment. What are we saying? All we try to emphasize is that at this level, the examiner is not going to be doing consolidation as usual, consolidation as a normal business for you to provide an answer and walk away. But the examiner is going to be bringing the best out of you in terms of the accounting standards. And the rule is the rule. We're going to be applying the same principles when it comes to dealing with the accounting standards. And so on the overall, yes, we have done the 95% upward of the syllabus, touching on those key issues that we must understand. Technically, what I want to maybe touch on additionally will be just walking through some few questions and principles here in the next few minutes, and then we should be out of here for today in respect of that. And you can go and then do your revisions and then wrap up your discussion as you bring your discussion home. But again, question 5, evaluation of financial statement. Question 4, specialized transactions. Question 3B, governance, ethics, sustainability. One of them will be there for 10 marks. Question 2 and question 3A, 30 marks on the accounting standards. We've covered 95% upwards of the accounting standards. Then question 1 is going to be your last question, which is going to be the consolidated financial statement. And as we mentioned, you are just going there to take some easy marks, get your workings done, not necessarily ending up extracting the financial statement. Then across these, we are going to have theories coming in because question 5B is going to be a theory question. Question 4B is going to be a theory question. Then question 5B, question 3B, the governance, sustainability, or ethics is a theory question, 10 marks waiting for you. So you're going to have a minimum of 20 marks questions on theory in question 5B, question 4B, and question 3B. That will add up to 20 minimum waiting for us in the exam hall. Now, the reason why that is important is because of what I keep on saying. When you get to the exam hall, you want to calm down and read through all the questions and take out the written questions first, 20 marks. You want to take out the written questions that you can answer best first, as quickly as possible. When you do that, it puts you in the position so that you can now come to ratios, evaluation of financial statements. You can now come to specialized transactions. Then you can come to the standards, and then you clean it up or wrap it up in the consolidated financial statement. So these are the things that we need to be mindful of, and that has been the guiding principle throughout the last 5 sessions that we've spent, or so 6 sessions that we've spent or so, in looking at these corporate reporting exclusive discussions, in addition to everything else that we have been discussing in the financial reporting class as we build our knowledge up going into the examination on Monday. And so before I get excited into my discussion, any questions for me? If you have any questions, something specific that you want to pick my brain on, you want to seek clarity on something, maybe you can raise your hand, I'll bring you up, or you put it in the chat for me. Something specific that you want to pick my brain on, I'll be excited to provide you with some answers in respect of that before we get goosebumps. Because really, as I said, I want to see how we can assist any challenges that you may be having. I think I saw a hand up, or was an error? Okay. It means we are in a comfortable lead then, and there are no issues to be dealt with. Okay, so I'm seeing. Yes, Joseph, your hand is up.
Okay, sir, good morning.
Good morning.
Please, my challenge that I want clarity on is the deferred tax, the treatment. Now, in question, if you look at the Bamboo PLC, we have deferred tax. We have Yes, we have deferred tax among the assets at the top, and then we have deferred tax liability among the liability down. Now, when I do the calculation, those tax, I don't know how to deal with them.
Bumble PLC, that is which question is that?
Question 4.
Okay, what we did in class, right? Give me a sec, please. Bumble PLC. Question 4 in which document specifically?
I think it
When
is
was
under
Bumble
the
when was Bumble PLC then? Okay, you
no.
give me a sec. Let me just see if I can bring that up because I think I know the question you're talking about. I'm just going to my slide here. Financial reporting. Financial statement questions. Yeah, I think the final question we solved on the single entity financial statement, right? Where we prepare statement of profit or loss and position. That's what you're talking about, right? Or what? Okay,
Okay,
let me address
okay, so
specifically your concern here without using the question. Let me address specifically what you're talking about in terms of the deferred tax issue. So when it comes to deferred tax, IAS 12, crucial accounting standard that we need to understand, income tax. Here is the play. We are going to be having, if we are giving trial balance, or if we have a trial balance, then it means that we are going to be having current tax in the trial balance, then we're going to have deferred tax in the trial balance. Now, these are opening balances. So the current tax represents the over or under provision of tax from the previous year and what we paid. So we said if last year you thought you would pay a tax of 10,000, but the GRA comes and say, hell no, you are supposed to pay a tax of 15,000. Then you provided only 10,000. So the difference of 5,000 becomes under provision of tax. That's an expenses. That is going to increase your tax liability. So under provision of tax will usually be on the debit side of the trial balance. So if we are giving trial balance and current tax is on the debit side, that is under provision of tax. That will increase our income tax expense figure that must be recognized in the profit or loss for the year. The reverse is true. If we made a provision of 20,000, but tax authority comes and say, you are supposed to pay 12,000. That means there is a difference of 8,000. The difference of 8,000 is over provision because you provided more than you paid. And so over provision is an income. You have provided less because reduction in liability is an income. So that will be on the credit side. And the current tax on the credit side is over provision, and that reduces your income tax liability charged for the year. So that's the implication of current tax. Deferred tax, as we said, is arising and is about accounting for the future tax consequences of transactions in the financial statement. And so for the deferred tax, it could be on the debit side, which means deferred tax asset, or credit side, which means deferred tax liabilities. And that is the idea there in respect of that. Now, in the footnote, we may have deferred tax coming in as a result of revaluation of assets and others. And we said you have to then calculate the movement in the tax that must be charged in the P&L or go to the OCI. The reason deferred tax liability or deferred tax movement will go to OCI is if it is as a result partly of revaluation. So if we revalue assets and we got revaluation surplus goes to OCI. So then any deferred tax movement as a direct consequences of the revaluation must also go to OCI. Then the balancing figure is what we take to the P&L in respect of that. That is the difference between what is presented in the trial balance and how it is dealt with and what is in the footnote and the movement, how we treat it.
Okay. So if I use, let's say, the T account, I should debit the one that is having the debit balance and credit the deferred tax liability.
Yes. So
and then now do what?
Yes. So if you are using the T account, you go to the trial balance. The current tax, which side is he on? Is he on debit or credit? Whichever side is on, that's the same side you will bring in your T account.
Okay.
The deferred tax, which side is he on? Debit or credit? Whichever side is on, that is what will come as the opening figure. So your balance brought forward could be on the debit side or credit side, depending on what is happening in the trial balance. Then number 2, you pretend to close. That's where the closing figure comes in. The closing figure will be based on whatever calculation or tax that the entity is expected to charge based on the current year's profit, or if you want, based on the issue in respect of revaluation of assets. So then the brought down is going to be on the credit side, then the carry down will be on the debit side. Then you balance. The balancing figure is going to give you the charge for the year if it's on the credit side. But if we are in a cash flow environment, then you are going to be looking for the tax paid. So the balancing figure will be on the debit side.
Okay. Thank you, sir.
Okay. All right. Any other questions for me? What else do we have? What else do we have? Everybody good? So as I mentioned, really it's about addressing issues that you may be having technically, because I mean, we've done, as I said, upward of 95%. So we should be in a comfortable lead as we get ourselves into the examination generally. Okay, so if there are no other questions, then let's look at some few stories and share some thoughts on some few issues. Still on the standards, still on consolidation, and then bring the discussion home. And if you pay attention, you've realized that in our discussion on Monday, we did some consolidation issues, consolidated cash flow analysis, consolidated cash flow preparation, right? And then I also want to touch a little bit on some consolidated financial statement issues with another question here as we build the story up, right? So just a mixture of some standards and consolidation issues, just a little, again, as we get ourselves excited. But please, as I said, 20 marks theories are going to be there. So the same attention you're going to pay to consolidated financial statement, allocate that same energy to the theories. You see, the reason I always say this is because the average corporate reporting student is just about console, consi kasako. That's all. The average corporate reporting student is spellbound on consolidation, and they ignore the 80% aspect of the syllabus, and all they are doing is console. So be careful. There are a lot of things in consolidation. We have addressed that already. That there are a lot of things in consolidation. So you have to know them. But be careful not to sabotage 80% of the syllabus at the expense of 20%, which you will still struggle in the exam hall with. And Nuntina, the strategy is to pass this examination with ease. Please go first to the written aspect. So please go over sustainability, go over governance, go over ethics. We've done these. You will see them in the exam hall. The IT issues, get them done. Because 20 marks is there. Take that out first. So that's the box you're going to be taking. Number 2, evaluation of financial statements. We have addressed everything that we need to understand when it comes to evaluation of financial statement, including consolidated cash flow analysis. Please master the act and take that out as your second question. Number 3 is going to be the standards. As you sit now, which standards? If you don't look at it again, Monday 2 p.m., if you see the questions, you can answer. Which standards? That's a question you got to answer. That's a question you have to answer. You have to be honest with yourself. Because passing the corporate reporting examination is not a rocket science. It's very easy. You just have to know where to play ball. That's all. You just have to know how to play ball. Take out specific areas and boom. You're going to be good at the end of the day. It's not rocket science. It's easy. So let's come back to our question kit that we've been referring to. The question kit we used on Monday, if you remember, we solved question 1 on Monday, the consolidated cash flow, question 1. And then yesterday during the discussion, we solved question number 5, Lyria Co, if you remember yesterday in the discussion. So that same question kit that we used on Monday, that we used yesterday, from there we want to address question number 3. Just a little bit, just a part of the question number 3. It has IAS 21, effects of changes in exchange rate, and some components of foreign subsidiary situation, because it's a crucial issue when it comes to the consolidated financial statement that you familiarize yourself with the foreign subsidiary issue, because it's an area that the examiner could get goosebumps in as you are going into the exam hall. So it's important we address that. So question number 3, in respect of that. Now, if you don't have this question kit, I don't know what you have been doing so far, but it's available for download under the Session 3 ERM on the website. Last week, Monday, this Monday, that was what we used. So we are looking at just the A and possibly B aspect of this question, and then we should be out of this particular question. Now, it says, please pay attention carefully here. It says, draft an explanatory note to the directors of Hamming addressing the following. To the directors of Hamming addressing the following. So that's what the examiner wants us to do. A, how the functional currency of Crochet Co. should be determined. Okay. How do we determine the functional currency of an entity? We know the standard. Then when the entity is a foreign subsidiary, how do we determine the functional currency of that entity? We discussed that as well. We're going to see how it plays out in a moment. Then the B aspect says how Crochet Co.'s customer contract should be accounted for in the consolidated financial statement of Hamming Co., which are presented in dollars for the year ended 31st of December 20X4. Then the last part, I'm just breaking my bounds, just reading the question so we know which part will be related to the question. A calculation of the goodwill on the acquisition of Crochet Co. in gourmets, and how it would be accounted for in the consolidated statement of financial position of Hamming Co. on 31st December 20X4 after translation. Include a brief explanation and calculation of how the impairment and exchange difference on goodwill will impact on the consolidated financial statement. So these are the things that we want to really address in the context of this question, and then we go away in respect of that. So let's go back up. Background. Hamming Co. is the parent company of a multinational listed group of companies. Hamming Co. uses the dollar as its functional currency. So the parent entity has a functional currency of dollar, or the dollar. Hamming Co. acquired 80% of the equity shares of Crochet on 1st January 20X4 and 100% of Quava Co. on the same date. The group's current financial year and it's 31st December 20x4. Okay, now we don't need this, but if we need a group structure, it's going to be easy. We're going to have Hamming score coming on top, right? Then we're going to have 100% ownership in Quaveco, 100% ownership. Then we're going to have the other one, Crochet Co. That one we own 80%. So NCI will come on this side like this, 20%. Now, so you have to be mindful of how you draw the group structure, right? Because sometimes students have problem even drawing the group structure. Like I said, we don't need it in this question, but because we are in class, it's important I illustrate that to you. So Hamming's group. So the group structure would have been the parent, Hamming's co. So it will look like this because they have two different subsidiaries, Quavaco, and then no, the way I've done, I will struggle with the second one. So please permit me. Let me see if I can go this way because I need some spacing. Quavaco, this one we own 100% of it, and then Crush It, Co, 80%. So NCI will be here, 20%. So that's the group structure. Like I said, we don't need it here, but you're going to need it in the exam also. Just illustrating that to you, how it's supposed to be structured. Let's continue. Crochet Co functional currency. The head office of Crochet Co is located in a country which uses the dinar as its main currency. Okay, so now the I aspect of the question said how the functional currency of Crochet Co should be determined. So this is foreign operations. How do we determine the functional currency of a foreign operation? We spoke about this under IAS 21. Now, it is at play in the context of this particular question here. The head office of Crochet Co is located in a country which uses the dinar as the main currency. So, the country whose economic policies affect the operations of the entity's currency can be the functional currency of the entity. So, yeah, step number one, we may think it is the dinar. But let's continue to read. However, its staffs are located in a variety of other locations. Consequently, half of its employees are paid in dinars, and the other half are paid in the currency of grommet. Ooh. So we are introduced to a second currency, grommet. Okay, so based on country, dinar. But then based on employees, half is in dinar, half is in grommet. Okay, we still cannot make a decision so far, but let's continue to read. Crochet Co has a high degree of autonomy. Ooh, that's a key thing for determining their functional currency. If they have a high degree of autonomy, then the US dollar currency of Hamming Co, the parent, cannot be the currency of the report of Crochet Co because they have autonomy. And is not reliant on financing from Hamming Co. Okay. Nor do sales to Hamming Co. make up a significant portion of their income. Okay, so the dollar is out. They are autonomous. They don't obtain any financing from the parent entity. Neither do they do significant transactions with the parent entity. So these three bases cancels out the probability of Crochet Co's functional currency being the US dollar, which is the functional currency of the parent entity, Hamming Co. Are you following the way we're building the story up? IAS 21, but in a group environment. Let's continue. All of its sales and purchases are invoiced in grommets, And therefore, Crotchet raises most of its finances in Grommet. It's getting interesting now. So now they are paying half of their employees in Grommet. Sales and purchases are paid for in Grommet. Number 2. Number 3, they raise funding in Grommet. Number 3. Let's continue. Cash receipts are retained in both Grommet and Dina. Okay, so that's again 50-50. Crotchet Co. does not own dollar bank account. Crotchet Co. is required by law to pay tax on its profit in Dina. So on the basis of this, the question then is, what is the functional currency of Crotchet Co.? So look at the scenarios very well. They live in a country that has the currency in dinar. They are supposed to pay taxes in dinar. They pay half of their employees in dinar. And they retain cash partly in dinar. 4. Then they pay half of their employees in Grommet. Their purchases and sales in Grommet. They raise financing in Grommet. They retain half of their cash in Grommet. On the basis of the size of purchases and sales and raising of financing, these are superior criteria. Hence, the functional currency of Crotchet Co. will be the Grommet. That's it. We are done. That's the answer to the question. We are done. Any questions? That's 5 marks. We are done. So, although we are seeing the scenarios up, right? They pay half of employees in Grommet. In dinar. The country they are in, currency is dinar. They pay taxes in dinar. They retain half of their cash in dinar. Yes, these are the 4 things. But let's look at the other 4 for Grommet. Half of employees in Grommet. Purchases and sales in Grommet. Raising of finance in Grommet. Retain half of their cash in Grommet. So the Grommet takes a significant stage in the entity's operations, especially the fact that all their sales and purchases are in Grommet and the fact that they raise money also in Grommet. So these supersedes the tax they are paying, the country they are in, its currency, the half money that they are retaining in dinar, and then the half labor that they are paying in dinar. So the functional currency of Grommet is, of Crotchet is Grommet. We are done. You see that it's not difficult, Scra. I'm saying that lightly, right? But that's the idea. So that's how we determine the functional currency of a foreign operations. So it cannot be the currency of Haminco because this subsidiary is autonomous. They don't get any financing from the parent. Neither do they do a significant sales with the parent. So that's why the USD will not be a subject matter of discussion at all. That's it. We are done. Yes, Joseph.
Okay, please. So I want to find out, is that always the situation that the purchases and sales, the purchases and sales currency should supersede any other factors?
It's about the transaction, the currency in which a greater size of the entity's transaction is dominated. That takes precedence of what determines the functional currency of the entity. So if you look at the fact that the whole entities, what they buy, the whole entity, their total sales in Grommet, Then number two, when it comes to raising capital, whether equity shares or loan, or they raise it in grommet. So these two take a significant size of the financial activities of the entity. It is for this reason why the size of the transactions denominated in grommet would take precedence over the size of transactions in dinar and even the country that they are in. So that's the basis for the argument. It's about size of transaction. That is what is taking precedence over which currency is the functional currency.
Okay. Okay, thank you.
All right. Now let's build it up to the second paragraph. Again, like I say always, reading, holding your breath, and then working yourself out. Knowing which part of the question relates to which portion of the answer so you can optimize yourself generally at the end of the day, right? That's very important. If you've been here for that long, you know that that's how we dance all the time. Let's come to the second paragraph. And that is what is going to lead us to the BI aspect of the question that says, how Crochet Co's customer contract should be accounted for in the consolidated financial statement. How the contract should be accounted for in the consolidated financial statement. So let's go. Harming Co paid cash of 24 million for the 80% holding on 1st January 20X4. Harming Co has a policy of measuring non-controlling interest at fair values. Now, so this is a foreign subsidiary. So if you understand the concept of foreign subsidiary, what did we say? We said you calculate the goodwill in the foreign currency, then you translate it using the exchange rate at the date of acquisition. Then any subsequent remeasurement will be done using the closing exchange rate. If there are any impairment in there, you're going to translate that impairment at the end of the year as well, so that any exchange gain or loss will be accounted for and recognized in the financial statement. So we're going to be coming into the goodwill calculation, but let's continue to read. The fair value of non-controlling interest on 1st January was $6 million. So you got to be careful here. Fair value of consideration transferred has been given in the dollar, the currency of the parent. Fair value of NCI has been given in dollar, the currency of the parent. But the rule is that you have to calculate the goodwill in the currency of the subsidiary. So it means we have to change these USD back into grommet, because we've now established that the functional currency of Crochet is the grommet. So we have to retranslate these using the exchange rate at the beginning of the year. Then we can calculate the goodwill in the foreign currency. Then we will retranslate it back to the home base. So stay with me carefully. You're going to get it. Don't worry. Since Crochet Co has a range of net assets held domestically and overseas, the fair value of the net asset at acquisition were determined in their local currency. Okay. Hence, the fair value of some assets have been determined in dinar and grommet. Okay, so a mixture. The total fair value of net asset denominated in grommet was 43 million grommet. Okay. The fair value of the net asset denominated in dinar at 1st January 20 SDS was 50 million dinar. So I want you to hold up and understand what is going on. So for the purpose of our workflow quickly, let's get the net assets of Crochet. So first, we are told that the one denominated in grommet, that one we don't need remember we are doing what's the sign? Okay, I thought they had a sign for the grommet. Since they don't have any sign, we have to write it in full grommet. So fair value of assets in grommet. We are told that is enye 43 milli. So grommet in million, 43. Then let's bring fair value of assets in dinar. So stay with me. They said 50 million dinar. Now come down here. They've given you exchange rate. We are at the beginning of the year. So the fair value of the asset to dinar for grommet is that 1 dinar equals 2 grommets. So if 1D equals 2 grommets, then how much in grommet will 50 million dinars be? Sekala? So what do? We multiply. Remember I told you that exchange rate, it depends on how it is quoted. So in this case, we will multiply. So the fair value in dinar is going to be 50 million by 2, right? And that is going to be 100 million in grommets. Okay, let's continue to read. So that is the total fair value of the assets so far. The one denominated in grommets, 43 million. The one denominated in dinar must be translated to the functional currency of the subsidiary because we need a net asset in one currency to be able to do our workings. Next, excluded from these fair values are several contracts with customers of Crotchet. Excluded. So these are going to be fair value adjustments, okay, that we need to be bringing to the net assets of the entity. So fair value adjustments that we need to be bringing to the assets. What do we have here? We are told that this contractual relationship prohibits customers of Crotchet Co. from obtaining service from any of the main competitors of Crotchet Co. They have an estimated fair value at 1st January 20X5 of 15 million grommets. Of 15 million grommets. So the contractual relationship must be forming part of the assets of the entity because that's an intangible asset, IAS, Ebaze, 38. 15 million grommet. But I want you to pay attention here because the examiner emphasized that you should tell him how the customer contract should be accounted for in the consolidated financial statement of Hamins Co. So how should we account for the contractual relationship in the financial statement? So I go here to that II part of the question, BI, sorry. So BI aspect, contractual relationship. Now that's an intangible asset in Hamins. Yes, Boniface, your hand is up.
My video is frozen.
Check your network. I don't think I'm frozen. Yeah, I think check your network, or you can briefly drop off and then quickly come in again because sometimes maybe your network would just be messing you up.
Okay, sir.
All right.
Thank you.
So how do we account for this? It's an intangible asset, right? So if it is an intangible asset, then all we are going to do is calculate the initial measurement, right? And then what do? We look at the subsequent measurement. So what should we do? It is 15 million grommets. So we have to translate it in dollars because in the consolidated financial statement, it has to be translated in dollars at the acquisition date. So if you check the exchange rate, $1 at the beginning of the year is ebaze 8 grommets. So let's see. If $1 equals 8 grommets, how much in dollar will 15 million grommets be? So in this case, what are we doing? We will divide. We will divide. We will divide. Okay. So let's go. Initial measurement. So we are working in dollars. Please stay with me. So if we are going to divide 1 equals 8 grommets at the beginning of the year. So 15 divided by 8, what do we have? 15 million divided by 8. That's 1875 in million. Then what do we do? This is an intangible asset. What's the accounting treatment? Intangible asset with definite economic useful life, what do? We amortize the cost or the fair value of the intangible asset over its economic useful life. But if it has no economic useful life or definite, economic useful life, then we test for impairment. Sounds good? So let's find out what is happening here. Let's read on. 15 million grommets. Now, we are not told. Okay, let's continue to read. At 31st December, it was decided to impair goodwill by 30%. The following are exchange rate. Okay, so we are not told how these contracts, how long they will give us the competitive edge. So this is looking like more of the, how do we call it? An intangible asset with what? Indefinite economic useful life. So there is no impairment of it as well. So let's look at the carrying amount at the end of the year so that we'll retranslate it into the consolidated statement of financial position. So carrying amount at 31st December 20x4. Still 15 million, the initial figure. But now at the end of the year, the exchange rate at the end of the year, 31st December 20x4, $1 equals 7 grommets. $1 equals 7 grommets. So now we divide by 7. So 15 million divided by 7. Hey, 15 divided by 7. That's 2.143, since we are working 3 decimal places. 2.143. So this figure is what will go to the consolidated statement of financial position under non-current assets. Okay? So consolidated statement of financial position. Because if you remember, we said assets will be retranslated using the closing exchange rate. And that is what will go to the statement of financial position. Okay? So what do we have? The difference is going to be what? Exchange difference. What would that be? This is an asset. So increase in the value of the asset is about a gain. So we'll get an exchange gain here. So what will be the difference? 2.143 minus 1.875. And that's 0.268. That is going to be the exchange gain difference in respect of that. All right. Now, this will be recognized in OCI, okay, and equity. Because this will go in other components of equity on the face of the consolidated statement of financial position, and will also be recognized in the consolidated profit or loss and OCI. It will go to OCI, not P&L, OCI. So that is the I part of the question. How Crotchet's customer contract should be accounted for in the consolidated financial statement of Harmins Co., which are presented in dollars for the year ended 31st December 20X4. So 4 marks, and only we are done. You see that it's not difficult, Kra? Very easy. And then it will also be included in the determination of the fair value of the net asset at the date of acquisition. But in the consolidated position, this is what we do. Easy peasy. So that is the BI. Now let's come to the BII, which is the goodwill that they said we should calculate on acquisition and how it should be accounted for in the consolidated financial position after the translation and all that. So goodwill in crotchets. Cool. So as I said, the way we play here is we're going to bring the foreign currency, grommets. Then we're going to have the exchange rate in the middle. Then we're going to have the dollar, which is the functional currency of the parent. I think we are working in million in either side. Stay with me. So how much did we pay? So consideration transferred. Now they paid, if you remember, back up. Now let me clean this so that we can get some clean sheet. As we said, they paid 24 million. But we have to bring that back into the grommet because we have to calculate the goodwill in grommet. So if you remember the exchange rate at the beginning of the year, $1 equals 8, and we said we are going to be what? Dividing. So 24 divided by, sorry, we are multiplying. Grommet to the dollar. Hey, maybe. Where did we do grommet to dollar? $1 equals 8 grommets. I got to be careful, please. Stay with me. $1 equals 8 grommets. It was $24 million will be equal to how much in grommet? So we have to multiply. Sorry. You could be doing this in a very wrong manner. So times 8, right? 24 by 8. That's 192 grommets. So that is 192 grommets. Then we bring in the fair value of NCI. So non-controlling interest. That also was in dollars, $6 million. So let's take that back to grommet as well. 6 by 8, that's going to be 48, I guess. And so that gives us the fair value of the business. Crotchet. Then we less the net assets at acquisition. Which we worked for earlier here. Can we get net asset? 140, 158. Right? Yeah. So 158. Take it out. And that gives us goodwill at acquisition. Now, that goodwill at acquisition would then be translated using the exchange rate at acquisition, which is the 8 million. Oh, sorry, which is 8, right? $1 equals 8. We'll come back to that. So let's get the arithmetics. 192, 48. That is 240. 240 minus 158. That's 82. So the goodwill at acquisition is 82. Grommet. So take it back into dollar. We'll divide by 8. And that is $10.25 or $10.25. So that is at acquisition. Now, what happened again? We were told that there is impairment in goodwill by 30%. Okay, so we're going to less impairment. At this point, it looks like my space is exhausted. But permit me, I can misbehave and create some real estate here in the exam, or you go to the next page. But I can create some nuances here. So impairment loss. The impairment loss, we are told, is by 30% at the end of the year. So end of year exchange rate, $1 to grommet is 7. So 30% of this figure, 82. So 82 by 1.3, that's 24.6. Now you got to translate that impairment, because it is at the end of the year, using the closing exchange rate, because that must go to P&L. consolidated P&L. And so the exchange rate is 7 at the end of the year. 7. So divided by 7, that gives me 3.51. That's going to be deducted. And so what will be the closing figure? The closing figure is then going to be 82 minus 24.6, and that is 57.4. So this is the goodwill at the end of the year, at the reporting date, which must go on the face of the statement of financial position, right? But it has to be translated using the closing exchange rate. So divided by 7. And that is 8.2. So when we go to consolidated statement of financial position, goodwill that will come there is 8.2. But you got to be mindful because there is a gap there between what is going on in respect of the figures we have. So the balancing figure is going to be an exchange difference. So what do you have? You have 10.25 minus 3.51, and that will give you 6.74. But then the goodwill figure has gone up to 8.2, and so you get a difference of 1.46. That is an exchange gain. Okay, that's an exchange gain. The balancing figure. Why is it a gain? Because anchor, the carrying amount in the dollar will be 10.25 minus 3.51. So it will be 6.74. The addition of these two guys is 6.74. Sounds good? But then when you do the retranslation, it is 8.2. This is an asset. Increase in the value of an asset is a gain. That is why the difference is an exchange gain. Okay? That's what's happening here. And that exchange gain, as we mentioned, is going to also be recognized in the financial statement and will be shared between NCI and CI. Impairment is also 3.5. You know, NCI is valued at fair value. So any impairment loss will be shared between the NCI and then the parent company in their profit, in their percentage of ownership, which is 80-20. And that's the idea in respect of this particular question. That's all. We are done. So what we wanted to illustrate, and I think I mentioned this on Monday when we're looking at the consolidated cash flow, right? I mentioned this on Monday, that there are styling of questions that the examiner is going to bring in the exam hall. That may, sorry, not will. I got to be careful about my choice of words. That may bring in the exam hall. That is contrary to your traditional consolidated financial statement workflow. What does that mean? It means that it's going to be contrary to your understanding of cash flow because your understanding of consolidated financial statement, because you have prepared, hey, console Charlie, extract the financial statement, open bracket. That's your preparation. But there are consolidated financial statement questions where the examiner is not interested in your preparation of the financial statement. The examiner wants to find out, can you walk through and explain how things should have been done in the financial statement, just like what we did in the consolidated cash flow on Monday in session 3 of our revision masterclass. And there are those styling of questions there, which the examiner hasn't visited yet. And there are no easy marks. Everything you're going to be doing will be based on your understanding of how certain transactions must be accounted for. And Nuntina, we are approaching these questions as well. So don't just bury yourself on the usual consolidation. Hey, I've seen financial statement, group structure, net asset schedule. Yeah, do that. And we've done that. But in addition to that, you have to understand this other styling of questions on consolidation where you are not doing your typical consolidation, but you have to explain how certain things must be accounted for in the consolidated financial statement based on the context of the question. That's it. And that's what we want to draw your attention on. And specifically in the context of this question, we are looking at the issue in respect of IAS 21, effect of changes in exchange rate in a foreign subsidiary environment, and most importantly, how that relates to an entity's consolidated financial statement preparation. That's all. We are done. Any other questions? Any other questions? Everybody good on this? We are done in respect of that. And so that is something we want to draw your attention on again for the last time as you are looking at the discussion on IAS 21, effect of changes in exchange rate and how it could be material in the consolidated financial statement preparation. And then number 2, showing you that there are consolidated financial statement questions where you won't be preparing consolidated financial statements, but you will explain how things will be done in the consolidated financial statement. And that is where students are going to fumble. Because anchor, if the financial statement is presented, they say presented, you could get some easy marks. But now the examiner says, how you know the financial statement should be, put it in writing with some little calculation, which is not your typical financial statement. It's the same thing, but in a different realm. And the reason why these questions are crucial at this moment is because of what I keep on telling you, that the quality of the ICAG examination is getting better. Is getting better. It requires high level of intelligence, high level of emotional intelligence, high level of wisdom in the application of the principles. So if you just go in as a robot, hey, then you're going to have a lot of troubles in respect of that. So basically, these are the things that you must understand in the context of this question. You will get access to my writing part in the live summary note folder so that you can refer to it and use it if you want to. So basically, these are the things that we must understand, bringing us up to that upward of 95% based on the syllabus. Again, Nhyira, so what should I focus on? Number 1, the theories. Question 3B is going to be on governance, sustainability, ethics. These 3 guys, one of them will be there for you for 10 marks. Or the examiner can bring 2 of them, 5 marks each. 10 marks, that's waiting for you. Question 5B is going to be a theory. And that theory could be on evaluation of financial statement or anything. Question 4B, where the specialized transaction is A, the B aspect of that question could be a theory question on consolidation or a theory question on standard. So you have to go back to read the theory questions on the accounting standards. The theory questions in consolidation. How do we gain control? Which entity cannot present consolidated financial statements although they have control? How do we account for purchase bargain, meaning that the goodwill is negative? How do we account for that? What are the actions the entity takes when goodwill is negative? What are the reasons why goodwill will be negative? How do we deal with joint venture arrangement, IFRS 11? So question 4B, 5-mark question, could be a consolidated financial statement question or an accounting standard related question. Now, question 4A is business valuation or financial reconstruction. One of them will be there. Nhyira, which one should I focus on? I am not the examiner. My job is not to tell you what to focus on in question 4A. My job is to teach you the 2 items that you must know there. And we have exhausted all the 2 topics extensively with questions. So please Be prepared for the two. And as we said when we're discussing these topics and solving the questions, don't say, oh, it looks like I like specialized transactional, but I don't like business. No, we don't care about what you like. It's about what is in the syllabus. Then you come to question 2A, question 2 and question 3A, which are the standards. Which standards should you focus on? I wish I could tell you. The examiner can play ball and can decide whatever he wants to do. But certainly we know non-current asset accounting standards are going to be featuring in some way, shape, or form. And so IAS 16, IAS 38, IAS 36, IAS 20, IAS 23, IFRS 5, IAS 37, these accounting standards will be featuring in some way, shape, or form in that 30 marks area. So whether you like it or not, as you are walking into the exam or these standards, you have to be good with them because they will feature in some way, shape, or form. Even if they don't come as a standalone question, you will need them in question 4A, specialized transaction, or question 1, consolidated financial statement. So the non-current asset accounting standards, crucial. You must know them. 16, 37, 38, 36, 20, 23, and IFRS 5. Non-current asset held for sale and discontinued operation. So these 7 standards, that one, you can take it to the bank because you're going to call on maybe 4 of these 7 in the exam hall on Monday, either as a standalone question or in specialized transaction or in consolidation. That is going to be there. 4 out of these 7 will be applicable because there can't be any financial corporate reporting question with examination without these standards, 4 of them coming out. So you're going to apply them. Then in addition to those standards, will be the exclusive level 3 standards which we spoke about. IFRS 2 share-based payment. Remember the deferred tax implication. IAS 19 employee benefit. IFRS 8 operating segment. So in addition to those 7, we need to be mindful of these 3 exclusives. Then once you are done with those 10 standards, the other standards too, you have to be mindful of them. IFRS 16, sale and leaseback. IFRS 9, financial instrument. IFRS 15, revenue from contract with customers. IAS 33, earnings per share. Then the other standards. So what am I trying to say? I'm saying that at least, as the rule has been, cover upward of 95% of everything in the syllabus. That is your ticket to pass the examination. And if you have been following our discussion, at this point in time, you may just have some little things that you have to share your thoughts on and, deal with briefly. And all other things being equal, you will be good. That's it. I'm done. I'm done. So, just like how I said yesterday, when you get to the exam hall, okay, take out all the written questions. And I said this in the beginning as well, okay? There will be theory question on question 3B. Go there straight. There will be theory question on question 4B. There will be theory question on question 5B. Those are done deal, 20 marks. There may be other theory questions under the standard or even consolidation. There may be theory there in the B aspect of the question 1B. So read through all the questions, take out all the theories that you can do best first. Save some time. I recommend do not answer consolidated financial statement as your first question. Let that be your last question. So the roadmap is take the theories out, come to question 5, evaluation of financial statement, go to the specialized transactions, go to the standards. By the time you are getting to consolidation, which is going to bother your brain because whether I like it or not, consolidation is going to be having some nuances there. you are in a comfortable lead and you can confidently pass the examination. It's all about optimizing your time for greatness, for success, and making sure that you put yourself in the position that the 3 hours become a fruitful 3 hours and you can pass the examination at the end of the day. All right? So that's it about that. And this is where the Lord God has brought us. And we're going to wrap up around it. As I mentioned, certainly before Monday, 2 p.m., if anything you want to pick my brain on, something that you want to see clarity on, please don't hesitate to reach out. You will be assisted. Some of you have been doing that already. You'll be assisted certainly before the examination. You can reach out and pick my brain on what you want to get assistance on generally at the end of the day. And just leverage the key summary videos. Okay. As I said yesterday, this is not the time to be chasing questions from crocodile, questions from the pit of hell, questions from Ahithophel. No. Just calm yourself down. Go through the things that we have discussed because that is how your exam is going to be. And ask yourself, the theories that will be in the exam hall, have I read them? Don't wait till Sunday evening before. No. Don't wait till Monday morning. Oh, Monday morning, when I'm on my way to the exam hall, or when I get to the exam hall, I will read all the theories. Because me, dear, when I read the theories, I forget. So it is Baba, you are a liar. You don't forget. It is a lie you've told yourself, and you have believed the lie. So just read through all the theories, then go back into the things that we have mentioned. Do your ratios. Do your consolidated analysis. Use the ratio analysis principle document, because at this point you have to go through each of the styling of the questions. What are the guiding principles on the adjustments that are needed and how you write out your analysis? So use the ratio analysis principle document. That is your gateway for that 15 marks area that you will see in question 5, because everything, whatever styling of question the examiner is going to present to you under the ratio, it is in that document with the guiding principles on how to approach the question. So leverage that document, go through everything there based on whatever styling of questions, the adjustments needed, and most importantly, how you write out the analysis. The blueprint is given in the ratio analysis principle document. Please use it. Use it. Then know that mostly in evaluation of financial statement, because you are in corporate reporting, the examiner will be coming from a consolidated financial statement environment. So be mindful of that. We don't know what the examiner is going to do as you go on Monday, but most of the time in the evaluation of financial statement, the examiner comes from a consolidated financial statement environment, which means your knowledge about consolidation will be crucial in that question 5 marks area, evaluation of financial statements. That is why we said there may be consolidated cash flow analysis. Even if we don't have consolidated cash flow, whatever the other 5 styling of questions, it may be in a consolidated environment. So if you don't know how to deal with NCI, you don't know the implication of acquisition on the financial statement and the various adjustments required, you may have au revoir mon ami in that 4 marks, in the question 5 marks area. So please be mindful of all of these things. Whatever you need to pass the examination has been provided. You have it at your disposal. Calm yourself down, leverage, use them, go through everything that we have discussed, especially in the last 6 sessions, in the corporate reporting exclusive sessions. Go through them, get your understanding well, and you should be good. Okay? You should be good at the end of the day. So that's it about that. We wrap up here. Wish you all the best in advance. As I said, I'm going to be on standby. Anything that comes up before 2 p.m. on Monday, you can reach out and you will be assisted. And we hope to see those of you who will be qualifying for graduation at a graduation ceremony. And those of you who have other papers to write also, we hope to see you in the next session as we continue this journey to empower you and provide you with the blueprint you need to pass the examination. Au revoir, mon ami.